Chapter 1, Introduction to Corporate Finance. In this chapter, we have no math, it's all concepts, very general things about corporate finance, which is what FRL 3000 is about. First, we will look at the main three questions in corporate finance. Then we will look at forms of business organization. In other words, how a business could be structured, like you're the only business owner or you are in some partnership type business and so on. Then the goal of financial management, then the so-called agency problem, what it means, in which form of business organization this is a problem, and how a corporation is controlled. And the last topic is on financial markets and how a corporation fits in. First, what is corporate finance? If you imagine a firm, let's say a pizza restaurant, then first you can think of where the money for this business would be coming from. And we can say that there are generally two sources of capital or funds. One source is from the owners, so maybe it's a partnership, right? So the owners, the original partners, they each pitched in some amount of money. And the second source of money is maybe money borrowed, such as a bank loan. So what happens with this money? Part of it is invested into short-term things, and the rest is invested into long-term investments. And the money will be working for the firm and generating even more money. So the first question is related to where the money is coming from, the cash inflows for the firm, called capital structure. The second question is called working capital management. In other words, how will the firm manage its everyday activities, such as selling its product to customers, borrowing money short term, paying to its suppliers. What about any sort of time delays with receiving money when the product is sold to the customers, things like that. And the third question within corporate finance is called capital budgeting. So this is all related to planning money for a long-term project, something that would be running for a number of years and require costs over a number of years and profits coming in again over a long-term time period. Capital structure can also be called a mixture of debt and equity. Debt is money borrowed, like loans. Equity is basically how much something is worth. So something that is yours, that does not need to be paid back with any sort of interest on top of it back to some lenders. For example, imagine Professor Chernobyl buying $500,000 house. Typically, banks require that you pay 20% of the house price out of your pocket. So I will be paying $100,000, which is 20% of $500,000 out of my pocket. So savings I have in my bank accounts, right? The money that's mine. This is equity. And the remaining $400,000 would come from a home loan from some local bank. This is debt. Similarly, a company may be worth $50 million, and out of that large number, $10 million would be equity. So this is the money essentially split between the owners. So the owners have $10 million in their pocket essentially. And the remaining $40 million would be debt. So that would come from some sort of loans. And the question on debt to equity ratio includes things like how should we decide on the proportions of debt to equity? Should they be 50-50? Should they be preferably no debt at all? And if there is any debt that a company is planning for, which type of financing should it use? So probably it would be determined by which type of financing is the least expensive. The second question is called working capital management, and it has to do with so-called short-term things, whether they're spent or whether it's the money that the firm has to spend or that it will be receiving. Essentially, you can imagine a standard balance sheet, and the two items that are important there are current assets on its left-hand side and current liabilities on its right-hand side. So it's things that are cash or that can be quickly converted into cash, or things that would be, rather than received, things that would be spent relatively soon, such as current liabilities. So it's all those things that we call accounts payables, accounts receivables, short-term loans, cash, inventory. All those things have to be managed on the daily basis, and they reflect day-to-day activities that the firm has to engage in. So the questions there are, should we buy our supplies on credit or should we pay cash? What are the advantages of each type of purchase? Should we sell our product to customers on credit or should we require them to pay cash? How much cash should we have set aside just in case? On the one hand, if we have enough cash to cover unforeseen expenses, that's a good thing. On the other hand, too much cash may not be wise because it's just sitting there. It's not really working for you. It's not generating any sort of return. And the last question is called capital budgeting. This has to do with planning money, expenses, and receipts long term. So planning long-term investments, making long-term investment decisions. This has to do with how much should we invest into some new business. For example, if it's a pizza restaurant, then maybe it would like to expand and open a second location somewhere. So how much should we spend on maybe buying a building that is for sale? So that would be planning some immediate expense. But this also includes planning down the road, what would be coming in, what would be coming out of the firm. And so essentially we need to do the so-called cost-benefit analysis over all future years that would determine for us whether this new project opportunity is worth investing money into or not. And maybe we have several investment opportunities, not just one. So we need to be able to compare them. How do we compare them? And the last item that's relevant here is what we call risk. How uncertain are future revenues? Are they guaranteed to happen? Are they very unlikely? Are there different possible scenarios? So all of this is captured in what we call capital budgeting.